I tried to provide a different perspective here outside of the doom and gloom. But that doesn't mean I'm not conservatively positioned for next year because we are anticipating volatility. I do think that we will likely see more volatility, especially for markets outside of the US. But what people forget is that you normally see huge currency devaluations when the US imposes tariffs on other nations. And that actually, I think, is a bigger risk than the GDP hit alone.
Several major international and political developments happened this week that we need to address. They have longer-term geopolitical and investment implications. So we're going to examine what happened and what these implications are. Starting with what happened in France, the French government was toppled in a no-confidence vote. In South Korea, martial law was declared, although it didn't last very long, but it does have longer-term investment implications for market perception, for stability and capital flows. Trump picks Peter Navarro as top trade advisor. We'll talk about what that means for tariffs. And the Fed signals slower path for rate cuts despite strong economy. On the back of what Fed Chair Jerome Powell said earlier in the week. So we'll talk about monetary policy objectives as well. You'll notice I'm using Ground News. It's a news source that I've been using a lot lately. They are the sponsor of today's video, so thank you for sponsoring the video. They're a great resource. What's unique is that they aggregate a lot of different news sources into one. So they're a news aggregator, very comprehensive news aggregator. They have a lot of unique tools that only Ground News has. Specifically, if you take a look at my screen here, the Fed signals slower path for rate cuts. This particular story was covered by a lot of different news sources, Inc., Fortune, Wyon, the Straits Times, and so on. They have a bias distribution meter, which shows you how left-leaning, how center-leaning, or right-leaning a particular story is. In this particular case, this story is mostly covered by what is determined to be center-leaning news media organizations. It also has what's called an ownership meter. It shows you what percentage of the sources are independent news. So in this case, 9%, 23% wealthy private owners, 23% private equity, 41% media conglomerates, and 5% corporation. It gives you a sense of who is behind the story. Very useful tool as well. Ground News has been my go-to resource for news. Not only does it have interesting, unique features like I just showed you, but their search bar at the top is also very useful. You can sign up today with their Vantage plan for half off at under $5 a month. Go to the link down below. Click on groundnews.com/David Lin or scan the QR code here to get started. Whether it's tracking crypto, stocks, macroeconomic news globally, domestically, Ground News has you covered. The interview today features Jay Singh, founder of the Special Situations newsletter. We'll be going over Jay's outlook for markets, macroeconomic developments, and how he analyzes this week's current events that I just read to you. Jay, welcome back to the show. Good to see you.
Hey, David. Happy to be here. How are you today?
Very well, thank you. You can check out our last interview with Jay from a few months ago. There was a lot of volatility in the summertime, Jay, when you first, when you were last on the show. Remember in early August, big declines in the stock markets worldwide. Not so much volatility since then. So your sentiment on the stock markets, has that sentiment changed since we last spoke in August? How are you feeling overall about your outlook?
Hey, so, there have been some major changes. I don't think my outlooks have changed for countries outside of the United States, but obviously the US has had a major shift in sentiment after the elections. And, that is obviously due to a number of reasons. It is due to the expectation of the extension of the original Trump tax cuts. It is because of expectations around deregulation. I think Bessent, Trump's new Treasury Secretary, wants the United States to produce an extra 3 million barrels a day of oil, which could take U.S. production from 13.5 million today to 16.5, making us 20% larger than Russia and Saudi Arabia in our production capacity. And business confidence, I think, is up, in some of the real-time coincident indicators, right? Whether you look at, some of the manufacturing, PMIs, ISMs, Philly Fed indicators that have come out, the new presidency has been essentially more positive for small business sentiment. So as a result of that, we've seen an uplift in certain sectors in the United States that had been underperforming the rest of the market. So, for example, with the steepening of the yield curve and expected deregulation, the day after Trump won the election, financial stocks were up double digits, right? You saw the biggest 2-day financial stock move in the XLF and KRE in several years. And at the same time, you saw companies in energy infrastructure, private prisons. Some of these names were up 30, 40, 50% in a period of 3 weeks. So I think going back to your original question, I think that there's been a big sentiment shift in the U.S. that has supported, small cap and mid cap stocks, while allocation overall, as we've seen more inflows in the market, has remained pretty steady to large caps. And then overseas, I think the U.S. market has just carried the rest of the world higher, given the U.S. is like 60% of the world's market cap. But the earnings outlook overseas hasn't really improved as much. It's modestly improving in Europe after years of high energy prices after the Ukraine-Russia conflict. And I think it's improving because of expectations of lower interest rates, which essentially will allow Europe to be more competitive with the rest of the world by pressuring its currency closer to parity with the dollar, and perhaps even lower than the dollar into next year. And at the same time, we continue to think that Latin America will be challenged as Brazil is hiking rates. The CELIC rate has been raised a couple times. India, I think the market overheated, so you're seeing a healthy correction there. And China is experiencing one of its biggest declines in consumer sentiment that we've seen. And its government deficit has, consistently now been above 5%. We think it'll be above 5% next year as well. And given the state of their demographics and their real estate market, they've had to do, I think, almost like a 1.4 trillion or 15 trillion yuan stimulus. And the majority of that stimulus was just bailing out banks and replacing local government debt with with sovereign debt. So I think outside of the U.S., there are a lot of challenges, but the U.S. market has carried global equity markets higher going into the end of 2024. I do think that we will likely see more volatility, especially for markets outside of the U.S. In 2025 because of tariff risk and foreign exchange risk. I think everyone tends to focus on tariff risk, which could negatively affect GDP, right? For example, if we have a 20% plus tariff with NAFTA countries, but what people forget is that you normally see huge currency devaluations when the U.S. imposes tariffs on other nations, and that actually I think is a bigger risk than the GDP hit alone. So I know we have a lot to cover, but I also want to spend some time talking about the positives. Why the U.S. continues to command such a high valuation versus the rest of the world, and it goes to my best of the worst thesis, and why we've seen the most speculative parts of the market rally going into the end of this year.
Before we talk about more of the positives, let's talk about some of the risks that I've heard from some of the people I've been talking to. Almost across the board, I've asked people what could potentially crash the markets or put the economy into a recession, and the consensus is the overdoing of tariffs. How concerned are you that tariffs imposed by Trump next year could cause this bull rally to stop in reverse?
So that is a great question. And what I will start with is, I think almost every time, we get on and do a video, we spend a lot of the time talking about risks. But I do think while the tariffs are a major risk, the U.S. is not a net exporter. So when it comes to, the U.S. economy itself, will it affect our GDP in a material way? Unlikely. Now, the second is inflation. When you think about inflation, we, we import, our economy is 70% services, 30% goods, right? Of the goods that we import, if we were to put a 60% tariff on China, which would be the worst case scenario, and between a 10 to 20% tariff on the rest of the world, using Besant's framework, where our allies and people who listen to us, people who trade on favorable terms with us, could get as low as zero, and it would be in a range. And I think that the net effect on PCE in my base case, which is 7% global tariffs and 25 to 40% tariffs on China, I think the net impact on PCE would be less than 0.7%. And I think the reason why people just jump to very negative conclusions is they just don't understand how foreign exchange works. A lot of the impact on the U.S. consumer, in a scenario where we do enact tariffs, would be offset by a strengthening dollar versus a foreign currency. So, for example, if, back in 2018, when we raised tariffs on China, the Chinese yuan or renminbi versus the US dollar, depreciated at a high single digit rate. And we didn't actually impose those tariffs. People forget. We gave China several chances to put out policies on IP, to work on better trade terms with the US. And it was only after 18 months when tariffs went into the teens. They started at 2%. So I do think that Besant, one of the reasons why the 10-year yield gapped out 70 basis points going into the election results was people were worried about tariffs, and they were worried about the reheating of global inflation because of them. In fact, the Fed's own Kashkari on November 10th, I remember him saying, tariffs could provoke a global trade tit for tat. But when you actually look at the numbers, what could it negatively impact the U.S., right? If we impose tariffs on Mexico, what is Mexico really going to do? They're going to impose, are they going to prevent us from consuming avocados, right? Like, what percentage of goods, right, could they really impact? Obviously Ford and GM, more so GM than Ford. GM produces a lot of its trucks in Mexico, right? GM's profits could be wiped out. So I'm not saying there will be no effects, but I don't think it would be a catastrophe, even if we got to the higher end of the range. The market might correct, but it wouldn't be a catastrophe for the U.S. economy. And I think it's really important for people to understand that the U.S. is separated by an ocean on both sides, right? Outside, our biggest trade partners are not China. The amount of trade we do with China is down 30% since 2018. So our biggest trade partners are really Mexico and Canada. And what I think will likely happen is we will we'll work out some arrangements with Mexico and Canada around immigration and, favorable trade policies. And those tariffs will likely be much lower than the 20% case that people are afraid of.
Yeah, let's take a look at some of the policies that Trump wants to implement next year. Tariffs aside, broad-based tariffs, we can expect retaliatory tariffs from other countries, but also tax cuts. Scott Bessent's 333 policy of stimulating growth, 3% GDP growth, 3 million additional barrels of oil pumped a day, and deficit to 3% of GDP. Currently, it's at 6.9. What special opportunities or situations do these policies present for investors?
Absolutely. So we have increased our allocation, over the last year to midstream MLPs. And we think that midstream MLPs and service companies within the energy sector represent, a earnings growth opportunity over the next 4 years under this new administration, more so than upstream oil and gas companies. And let me explain very briefly why I think that. So, outside of the obvious trades like private prisons, where we've doubled on Geo and names like CoreCivic have followed, energy is more nuanced. You have upstream companies that drill for oil, right, in Permian and Bakken in the U.S., for example. You have companies that that have refiners, refining businesses like Valero, where you buy the crude oil and you refine it and earn a crack spread. You take 3 barrels of oil and you refine them perhaps into barrels of gasoline and 1 barrel of heating oil, jet fuel, etc. So you make the spread in between, and that business is less sensitive to the actual price of oil. And then you have the midstream. Midstreams, businesses tend to either be interstate pipelines, so across states, intrastate pipelines within states, gathering assets, gathering oil and gas from fields, storage assets, and they tend to be less sensitive to actual oil prices. Now, one thing that people, I think everyone understands, given where oil is trading today, around $70 a barrel, is that we have adequate supply of oil right now, globally, right? OPEC has had to cut production over the last 4 years and keep production lower than their spare capacity in order to keep oil prices from falling below 60. And what has happened as a consequence of that, as Saudi Arabia is producing at 80% of capacity, is that the U.S. is taking market share by drilling more and more in its lowest cost basins, to the point where just today we had the EIA report, and essentially U.S. is producing about 13.5 million barrels a day of crude. That's more than Russia and Saudi Arabia. That is keeping a lid on the price of oil. So Trump, contrary to people's belief, Trump's not good for oil prices. In fact, Trump is going to encourage production, which will put pressure on oil prices, which actually will offset some of the tariff inflation risk by pushing energy prices lower. But it's very good for companies that are building pipelines. There will be more pipeline permits. There will be drilling on federal land, and those companies make essentially a volumetric tariff on throughput through their pipelines. And as a result, we think that those companies, which saw multiple compression over the last 7-8 years, will finally start to see multiple expansion as earnings growth rates go up. So that, I think, is one area that I think we'll see a massive benefit. The second area, which you've already started to see, is financials. Financials, due to deregulation, like if you listen to Jamie Dimon, he's constantly pounding the table and saying, we have too much capital at JP Morgan. We can't take risk. These banks were at 40 times leverage, and Lehman was at 40 times leverage during the great financial crisis. Now they're at 10. I'm not saying they should, lever anywhere close to where they were, but what will likely happen is, you could see, when it comes to, trading, relationships with consumers, small businesses, capital required on balance sheets, ability to trade in asset classes like crypto. I think you'll see deregulation on a number of fronts, which will allow banks new avenues to make, return on equity capital, which is their levered equity return. And as a result, you have seen the banks anticipate that, and you've seen massive rallies in the banking sector. And then third, the 333 policy from Bissett, I think is very astute, because, one of the things that I'm still worried about, you asked about risks, is I'm worried about the bond vigilantes. And, I'm worried about the fact that our deficit is, without cuts, without the Department of Government Efficiency, and we'll talk about that in a minute, but without cuts to our government spending, I actually think under this administration, we will see debt grow by an additional $6 trillion due to the extension of the Trump tax cuts, no taxes on tips, no taxes on Social Security, and the $5,000 tax credit per child in the United States. So that is about an extra $600 billion a year of debt that's going to be added to our $36 trillion of federal debt. And the only way to essentially keep our debt to GDP ratio, below 150 over the next, several years is by growing GDP, right? So by increasing productivity, by increasing our domestic energy production, we can grow GDP. At the same time, we're going to need to do means testing. We're going to have to, cut government spending. Our Department of Defense, has basically an $850 billion budget, and they've failed audits for the last 7 years, right? Over the last 4 years, there's been $280 billion a year of misspent or mistaken spending by a federal government out of 6 trillion, right? That's almost 5%. You would expect, maybe a 1% error, 50 bips error, but for a government of our size to have, 5%, of mistaken spending, I think they can cut that. One of the things that people don't understand, though, is the number of government employees. Our federal government employees, are less than 15% of our total government employees in the U.S. So, we're not going to save that money just by firing people in our federal government, right? We're going to have to, take broader steps. We're going to have to put pressure on pharmaceutical companies, on healthcare companies through Medicare and Medicaid. It's going to be a much longer conversation. And what Bassett said, and I think he's a lot more straightforward when it comes to actually getting to facts and figures. He wants to reduce our deficit from 7% to 3%.
Yeah.
Right. With his 3-through-3 plan and by cutting. So he's not saying that our debt is not going to go up. In fact, he is affirming that our debt's going to go up every single year of this presidency. But our debt needs to grow up at a pace that's slower than our rate of GDP growth, if that makes sense. And that is what his plan is trying to accomplish.
Are there any sectors that you think will not do well under a Trump second term?
We were short renewable companies, like solar companies. If you look at, for example, the Invesco Solar ETF TAN, it's been ever since there's even a whiff of a hint that Trump was going to win, and probability started to go up. I think at the beginning of October it was at 43. Now it's at 36, right? So that's a very, very steep decline, in the collection of renewable companies that it represents. So I think those, I think pharmaceuticals, biotech, due to, uncertainty, and renewables, it's not even due to uncertainty. We know that Trump is going to be repealing, a number of subsidies, like the EV subsidies, the 7,500 at the federal level. He's probably going to withdraw subsidies for solar and renewable companies in the U.S. and wind. So I think that he's also going to perhaps ease some of the regulations around, efficiency of automobiles. So I do think that those are areas that could definitely underperform. And I also think that legacy media companies, perhaps could underperform as well. You've seen their viewership fall dramatically over the last month.
Elon Musk joked about buying MSNBC.
He did. I don't know if he, and the funny thing is, he very well, could eventually, partner with someone, and have a news and television channel. I mean, look at Rupert Murdoch. I mean, owning media has been a classic move for billionaires over the last several years. Controlling the narrative has been really important. I mean, Jeff Bezos, look at his ownership of the Washington Post, right? So I do think that it's a possibility that Musk will continue to grow his media empire, and through the recent capital raises at XAI, and I think it's almost $100 billion valuation. Some of the investors in Twitter are actually going to be made whole, or could be made whole. So I think that everyone has been a Musk. And I think a lot of people have been hard on Musk, but and there are a lot of things that I disagree with when it comes to certain tweets. And some of them he might mean them in jest, but in reality, I mean, he is one of the most innovative people on the planet, and he focuses on core principles, understanding business from its fundamentals, and he uses common sense to an extreme. And I think it's something that the U.S. people the U.S. population just got frustrated with. A lot of common sense concepts are being ignored, going into the election. And I think that a lot of small business owners who tend to be in their 40s, and 50s, are celebrating that, and that's one of the reasons why you saw some animal spirits enter the broader market.
Speaking of monetary policy, Jay, Fed Chair Powell today was speaking to a group of reporters in New York, I believe. He highlighted the importance of independence from politics. He was alluding to, of course, the possibility that Trump could step in and directly, not I don't want to use the word control, but influence Federal Reserve politics. I mean, Trump has even alluded to the possibility in the past of having a seat, the president having a seat on somehow on the FOMC Board of Governors. But we'll talk about what this means and whether or not interest rates would be affected by politics into 2025. Do you think that plays a role at all?
Yeah, I mean, I do think that we will have fewer cuts next year. Okay. Um, you did see over the last 2 months that because of consistently better than expected consumer spending and GDP in the range of 2 to 3%. Even if you go to the Atlanta Fed GDP now, even for the fourth quarter, which was expected to slow down, to 1%. If you were to speak to any economist at the beginning of this year, the Atlanta Fed GDP now is 3.2%, which is unbelievable, right? It's actually increased. It was 2.3% a month ago. It's actually increased going into that. And this growth story, I think people find it hard to believe. But I spent a couple months in Europe over the summer, and I was talking to a number of business owners and investors and allocators, pensions, endowments, insurance companies, and what they've said is a number of these people are they're trying to move their businesses to the U.S. They're trying to do more business with the U.S. And you can see that with fund flows as well. There's been almost $2 trillion of foreign capital that's come into the U.S. Since COVID. From Japan, from Europe. And I'll get to one of the topics I wanted to cover. I did want to make a quick correction. XAI was valued at $50 billion in their latest round.
Yeah.
But just going back to why is the U.S. outperformed so much, right? In the recent years, it's been because of increased productivity through cost cutting, improving revenue per employee. For the S&P 500, we're at almost $600,000 per employee. We are at 13% operating margins, which is the highest in history. And number two, it's been due to increased household formation, right, through legal and illegal immigration. As post-COVID, doors are open for people to come into the country. And number three, I think has been due to the fact that people have underestimated the impact of government spending, and that I think has supported GDP growth. And number four, because we have fixed mortgage rates, right? Consumers have with a 30-year mortgage, and what people don't tend to focus on is that 40% of mortgages are actually now fully paid off in the United States, which is unbelievable. And the 60% of people who do have mortgages, 95% of them have fixed rate 15 to 30-year mortgages. So, with this sharp increase in interest rates over the last 2 years, people haven't really seen that impact to their bottom line. And as a result, they're increasing their credit card borrowing, they're increasing their auto borrowing. And at the same time, they're able to do that while keeping their fixed charge ratio, right? Their income to their total expenses, including interest, right? Reasonable. And eventually, we're going to see some rising delinquencies. But for now, consumers have been able to raise their spending, that way. So the U.S. has been an unbelievable story. But everyone knows that story because I'd say the majority of investors, right, who new investors who've entered the market, right, are millennials that weren't even trading prior to COVID, right?
Yeah.
At least a third of the investors that are going to be viewing this video weren't investing before 2019. And what they don't understand is this is not, the things that we're talking about are not near-term phenomena, right? Any pundit on CNBC will say, equity sentiment is the highest it's been in over 2.5 years, right? The risk premium for equities is the lowest it's been, since 2020. However, what people forget and what they miss is that U.S. operating margins have been a bull story for the last 25 years, like going back from 1995 to 2004, right? If I gave you today, operating margins are at 13% for the S&P 500. What do you think they were on average for the 10 years from 95 to 2004?
95 to 2004, like a CAGR, you mean?
What was the average margin of an S&P 500 company?
You know what? I can't even tell you. Please
Don't worry about
let
it.
us know.
So, the 10 years from 94 to 2000, from 95 to 2004, we were at a 6.9% operating margin, less than half of where we are today.
Okay,
That
so
was only
I'm glad I didn't say anything because I was guessing a much higher number in my head.
No, absolutely. And I think most people would. But that's almost, to 2004, that's 20 years. To the midpoint, that's 25 years, right? And then, if we were to fast forward to pre-financial crisis, 2006, right? What do you think operating margins were for the S&P 500? And what do you think they were comparative to the Euro stocks, the MSCI World, and emerging markets? So I'll just
Um,
provide some
let me just guess. Is it going to be, it was higher than 6.9, right?
100% higher. Yep.
Higher. Okay. So yeah, EMs were probably doing better before. So I'm going to say maybe 20%.
From 6.9%, U.S. margins went to about 9.5% by 2006. Okay, before the GFC, because we saw a big contraction in the GFC. At the same time, the Euro stocks was around 8, so not very far off, only a percent off, and you'll see why this is important in about a minute. And then you look at emerging markets. Emerging markets were close to the U.S. at about 9.5%.
Okay.
Right. Then you went to the GFC. Everything went to between 5 and 6%. You saw big earnings contraction. And since the GFC, okay, it's been over 15 years. And we've seen an unbelievable change in global equities, right? The US is now 60% of world market cap. Our GDP has grown 55% greater than the entire continent of Europe. I'm talking about the cumulative growth versus the continent of Europe, the cumulative growth of Europe on a percentage basis. Our economy has grown, including inflation, 55%, at the same time that the European economy has lagged. Okay, now what's been driving our equities? It's not just that growth. The average margin of an S&P 500 company from 2006 to today has gone from 9.5% to 13%.
Mm-hmm.
And for Europe, it's been flat for 15 years. Okay? And for emerging markets, it's actually gone down. It's actually gone from 10% down to 8%. So emerging markets have actually become less profitable over the last 15 years on average, right? The US has increased its profitability by 40%, and Europe's been flat. So people say, they compare PE ratios, but comparing PE ratios, it might have made sense in 2006, right, when margins were quite similar between EM, Europe, and the US. But one can argue that today, the US actually deserves to trade at a massive premium to Europe and Asia, because you can point to almost any single company in the S&P 500 today. It is either an oligopoly or a monopoly, because our government has been a lot more hands-off than places like Europe, right? The most profitable companies in the UK, for example, are oil and gas companies, right?
Yeah.
They generate about up to $2 to $4 million per employee. But in the North Sea, they're getting taxed at over 70%, David. It's unbelievable. They're getting taxed at 70%. They have they not only have corporate taxes, but they have these additional fossil fuel taxes in the North Sea. So people in the UK and Europe just feel like they're penalized for making money. You look at, the highest tax rate in France, right? It's over twice our tax rate in the US, and they're looking to put an additional tax because of their budget deficit. And it's one of the reasons why the government just collapsed.
Yeah, let's talk about that. So the government just collapsed. You tweeted about this as it was happening. Any ramifications for markets, Euro stocks as well as S&P 500? I mean, clearly the U.S. markets weren't affected, but I'm wondering if a change of relations between the new government and the U.S. could change the way trade happens, and affect margins ultimately.
So one thing to note, I'll just provide a caveat here. The impact of what happens in Europe on the U.S. Is much lower than it has been in the past, right?
Yeah.
Germany today is only 2.1% of global stock market value, right? no, 9 out of 10 people I talk to don't come anywhere close when I ask them. Because on a GDP basis, it's a much larger percentage of the global economy. It's only 2%. France is very similar, around 3% of global market cap. So what we saw happen in France was very unfortunate. Um, was we saw a no confidence vote, and I'm not going to spend too much time on it because we have a lot of topics to go over. But essentially, the French, I won't call them far right. I'll just call them the French right. Joined forces with the left to essentially topple Macron's government. And Emmanuel Macron had pitched himself, against the far right in France when he became president in 2017. But since then, he promised no increases in taxes. And what have we seen? Increases in taxes. And at the same time, the quality of life for the average French person has gotten a lot worse because of higher fuel prices, et cetera. So what we saw is just a rejection of the status quo. So essentially, at the National Assembly today, you could see photos of Marine Le Pen, just rejoicing as the no confident vote was playing out. So Macron is relatively young at 39 years old. Essentially, he's lost power. The CAC 40, which is the French index, has rarely underperformed the Stoxx 600, the Euro Stoxx, but it's actually underperformed because people were expecting this by about 11%, which is the broader European index. German stocks, for example, despite the German GDP in a double dip recession because of its lagging auto sector, German stocks are actually up this year because of expectations that the ECB is going to cut rates.
Yeah.
But France has underperformed by 11%, but it didn't affect the U.S. at all because of how small, how insignificant, their market actually is, right? Now, when you think about the same thing happened with Korea, right? We saw, martial law almost be declared in Korea overnight.
Yeah,
And
it was.
I
And then
think
they
that,
canceled everything 6 hours later.
yes, they canceled everything 6 hours later.
Yeah.
Immediately after they announced martial law. I mean, um, you know, members of the ruling party themselves were surprised, and immediately, the Central Bank of South Korea, offered infinite liquidity.
I saw
That was
that. You
headline on
tweeted this.
Bloomberg.
I had this on my screen and I wanted to ask you about this. Like, what unlimited liquidity? I I mean, could you imagine if the Fed made a similar announcement, the S&P would be at 7,000 in a day. But anyway, um, broader monetary policy implications of this event. I'll let you continue.
No, so I mean, what we saw was like a six hour market sell off in Korea, and I think we have a number of subscribers in Hong Kong, Singapore, Japan, and I was talking to a number of people overnight, and there's some news coming out that there are protesters outside the National Assembly, that the opposition leader, I believe his name is Lee Jae-myung. I apologize if I'm mispronouncing it. Was live streaming
Yeah.
within 20 minutes of Yoon's announcement, and you saw people that were gathering in frustration, right? And I thought, okay, this is a democracy, right? They only had like 200 armed troops, right, at that time, and a couple military helicopters. This is not going to be a big deal, and they're likely going to have to it's either going to be in a few days where they call this off, or they're going to have to call it off right away. And then when the news came out that that the central bank was providing unlimited liquidity, I immediately went out and I started buying EWI, and shared it in our educational Discord, and I even sold puts, like 52 strike puts, which that premium basically got obliterated. I mean, you made 50% in like 2 hours, and 60, 70% within a day after that. But what was interesting, despite what was going on in Seoul, and in France, it really didn't affect the U.S. market at all. In fact,
No.
the S&P 500 made its 56th all-time high this year. The VIX is at 13.
Do you think it could affect the dollar, though? People are looking at all these volatile political events all
Dollar's
around the
going up.
world. Yeah. And they're thinking, well, maybe the dollar, the US is still a relatively less volatile political environment compared to everything else that we're looking at this week. And maybe it's time to move some capital into the DXY.
What's really interesting is that
I'll just put this on the
outside
screen.
of gold,
Yeah.
okay, the US dollar is still the safe haven and still the reserve currency. And the reason why is it's the best of the worst. People have been talking about, China's, deficit is less than the US. I mean, listen, since we started putting tariffs on China because they had a very large current account surplus and we had a big deficit against China, since we started our tariffs in 2018, right? China's had a budget deficit of between 3 and 10%. Chinese budget deficit is going to be close to 5%, right? That's close to France. So people who are saying, we're going to have a new BRICS currency, China's going to, just 4 or 5 years ago, the Financial Times and the Wall Street Journal predicted that the Chinese GDP was going to be greater than US GDP by 2030,
Mm-hmm.
right? And we're nowhere close, right? And I think what people fail to understand is that the Chinese economy and is very focused on a handful of sectors. And if you look at Europe, you look at their economies, you look at each country, they're actually focused on a number of sectors, right? Germany, right? You have autos, and I'm not going to go through every single sector, but in France, you have luxury, right? Handbags, apparel, you have LVMH, right? Christian Dior, and in certain parts of Europe, it might be wines, it might be, but when it comes to technology, when it comes to industrial firepower, when it comes to domestic energy production, right, the U.S. has several advantages over the rest of the world. And, we also have a rule of law and a government that, and I hope it stays this way, has a freedom of speech that's supported by the Second Amendment, and where we're not so overregulated to the point where small businesses continue to grow and innovate. Right? If you go to Germany, for example, very few people actually own their own homes. Not only that, if you're a multifamily or you own apartment buildings, you have a stack of regulation, 4 yellow pages thick on what you can do, what you can't do, what type of HVAC you need, what type of filtration you need for your building. For a small business to actually grow, it's completely cost prohibitive. So I do think that the U.S. is the best of the worst, and I think that we are giving some of our competitive advantage away now with our 120% debt to GDP. If we can get our deficit under control and get our debt to GDP in control, I think that the U.S. will continue to be a superpower for many years to come. And I think that another thing, another reason why long term this can be supported is that the Chinese working class population peaked in 2018. You look at the actual birth rate in Korea; it's 0.68. To have a population demographically that can sustain itself, you need 2.2 births per couple. And the U.S., our rate is also about 1.2, 1.3, so it's below the replacement rate, but we have immigration, right? We have both legal and illegal immigration, whereas in Japan and Korea, which are xenophobic, you don't have people moving in to start new life. So what I think people are realizing is that, in emerging markets, you have corruption issues, you have, Lula is a complete socialist in Brazil. In China, you have demographic problems, real estate problems. In Europe, you have demographic problems and overregulation, high taxes, lack of innovation. Where are you going to go, right? You're going to put your assets in the U.S. currency and U.S. currency denominated assets.
Yeah.
And I know it's getting extended, and I know that things are overvalued, and I feel it every day. I'm a value guy. I feel I resist the urge. I look at something 4 or 5 times before buying it. But when you look at what's happening in the rest of the world, you have to understand that things are kind of, while they might be marginally cheap, they're not as cheap as they appear on PE because margins and growth are also much lower around the world.
Trump picks Peter Navarro as trade advisor. This just came in today. Navarro will be tasked with helping to successfully advance and communicate the Trump manufacturing tariff and trade agendas. This is what Trump wrote on social media on Truth Social. Now, any changes to what we already know about his plans for trade now that Navarro is appointed?
Yeah, I think Navarro supports. I think a number of outside of dissent. I think that people have said you know Trump has appointed people who he thinks will agree with his primary objectives, and I think that with the appointment of Navarro, who's 75 years old, was released from prison after serving a 4-month sentence for defying a congressional subpoena. I think that Trump thinks he's giving him a chance, and that Navarro um, feels that he was treated horribly by what they call the deep state, and he also is a proponent of America First trade policies, including steep tariffs to protect domestic industry. So I think that he will do exactly what we expected with respect to the tariff and trade agenda. I think that when people talk about Lighthizer, um, it was viewed in a very similar light. But I do think that the one hire that Trump made that I think anybody would have could have appointed based on just pure merit, which is Besant. I think the reason why the 10-year one of the reasons why the 10-year Treasury came off the almost 4.5% level and today's at 4.8, 4.18,
Yeah.
4.19 is that they think that, in Besant's own writing, that he is more measured. And he's not the type of person that's going to put 25% tariffs on the country right away. He'll say, okay, we'll raise them by 2%. Will you help us with our drug issues? Will you help us with, our mutual, trade benefit? Will you help us with IP protection? If you do, we're not going to go gangbusters on you. And, he's going to tier countries at different levels. So while I think, Navarro is going to do exactly what Trump tells him to do, I think what he does will be balanced by, Besant. So I do think that I expected someone like Navarro to be appointed, but I'm not too worried about it. Now, after everything that has been said, it doesn't mean that we're not going to see volatility next year. I absolutely think we're going to see more market volatility next year than we saw this year. I just don't think it's going to be a complete economic disaster like 8 out of 10 market pundits are predicting, because
Yeah.
there are several reasons why we continue to see money coming into the U.S. from the rest of the world. And it's simply that the rest of the world is faring a lot worse than the U.S. is economically.
It's interesting because even on my own show, I've noticed that the sentiment has shifted to becoming more sanguine when it comes to risk assets for next year. So even some of the bears from earlier in the year have started to shift towards more neutral, if not outright more bullish. I want to finish on the 10-year yield. You brought up how the 10-year moved on percent. How do you expect the bond market to perform next year? The 10-year has been sliding. If you look at the overall trend from the middle of November, big upswing on the DXY and the 10-year when Trump was initially elected, when the news came out on the 5th of November, but it's been going down ever since. Are you bullish on bonds in the Treasury market next year?
So we actually have a small short at 418. We're actually also short home builders because of rising mortgage rates. Mortgage rates, approach almost 7%, almost year-to-date highs.
So did you say rising mortgage rates? They're going back up?
Well, mortgage rates, if you see from September to November, rose very dramatically, almost to the highs of the year, alongside the 10-year. So what you saw in the 10-year was when Powell cut by 50 bips in September, Druckenmiller actually went, full tilt short treasuries. I think, decent amount of his portfolio, over 20% of his portfolio. And, we also went short treasuries. Why? Because we thought that Powell was cutting, too quickly, given that, inflation was kind of range bound, right? It wasn't going, we didn't expect it to end the year below 2. And we also thought that unemployment at 4.1%, was fairly stable. People are losing their jobs, but at a reasonable pace. So as a result, we thought that 50 basis point cut was a little bit dramatic, and it would result in growth accelerating, um, and confidence growing and financial conditions easing. And that's exactly what happened. Almost immediately after Powell cut 50 bips, bonds started to sell off dramatically, and to the point where going into the election, I think we peaked, a couple weeks after Trump was elected, because of some of the tariff fears, because of accelerating, consumer confidence, and right after he was elected, and also, steady consumer spending. But we think that, after Bissett was appointed, and also just, as a result of exhaustion, people shorting bonds, I think we've seen a breather. I think we'll likely be range bound until the inauguration in January.
Mhm.
So I don't expect an immediate sell off, but we own, if you know our product, we have, a venture-driven platform, we have an income platform. We go through over 700 baby bonds and preferreds, with very, very high yields, some, as high as, 15%. With the Lumen baby bonds we bought that are at 50% now. But, after this 30 basis point rally in the 10-year, we still think that there's a risk that due to high deficits and tariff announcements in the first and second quarter of next year, we have a small short in both the 10-year and a relatively new short in home builders after the terrible October numbers. Home sales were down 17%.
Great. Well, good update. Good analysis for us today. We'll end it here. Jay, where can we learn more from you and read about your special situations in your newsletter?
Sure thing. So we run a balanced newsletter at specialsitsresearch.com, where we have both long and short positions, with a heavy emphasis on income. Secured, unsecured bonds, floating rate securities that offset equity volatility. So the majority of our equity investments tend to focus on mid-cap value and growth, where we try to find differentiated ideas, outside of mainstream media and Wall Street coverage. Names like Geo, CXW, Opera, which will benefit, if Google is broken up. But several, names that I think that, the market tends not to focus on. And you could find us on Twitter at specialsitsnews.com. You could also find us on Threads at Special Sits News. You can also find us on B-Sky. There's so many new social media sites now at Special Sits News, and on YouTube at Special Sits News. And our website is specialsitsresearch.com. We have a team of analysts that are working hard for you. And despite the market volatility, we found a number of ideas that are trading at massive discounts to the S&P 500. Including one potential energy company that could benefit under this administration, where it owns midstream assets and you're getting the holding company essentially for free.
Yeah.
So what we try to find is companies trading below cash, companies trading below their net asset value, companies that essentially could be acquired, or companies that have very high income yields that the market doesn't understand, and then try to put together a decent risk reward list of ideas for people to do their own research on. So I appreciate the time to kind of share my views here. And I tried to have, because I've watched a couple of your recent videos, I tried to provide a different perspective here outside of the doom and gloom. But that doesn't mean I'm not conservatively positioned for next year. We have over 20% cash in our portfolio, because we are anticipating volatility. We also have, considerable allocations, to AAA securities, CLOs, in the AAA tranche, not the equity, along with, mortgage bond allocations that are backed by, Fannie Mae, Freddie Mac, and a considerable number of rated term preferreds and baby bonds to offset some of our equity exposure. So, and we also do have exposure to gold, and we didn't get to talk about, MSTR and Bitcoin, but we could touch on that on another call. And how the convert market works.
Good. Thank you very much. We'll put the links down below. So follow Jay there. We'll speak again next time, Jay. Always good to have you on the show.
Absolutely. Talk to you soon.
Thank you for watching. Don't forget to like and subscribe.